Hello there, everybody. Welcome to today's webinar. This is Craig at MAX, along with Chris and Eusebio, and it's our pleasure to welcome you to this introduction to MAX Advantage services. Some of you know a little bit about one service or the other. Some don't know anything, so you're in the right place to learn all about it today. I think all of us would agree that trading is never an easy job. Fun, yes, but not easy. And every advantage we can get is always very much appreciated. So today you'll get a look at the rather unique services that we are making available to traders. We are so grateful to Eusebio, who has done a ton of hard, tedious work and researching and preparing and testing and making everything ready. And so he's here to tell us all about it, and our hat is off to you, Eusebio, and I'll give the microphone to you.
Thank you very much, Craig, for this introduction. So, hello everyone, nice to see you for this presentation. Let's start with the content of today's presentation, which will not be a long presentation, by the way. So, you know that understanding the global context is an essential component to get some edge or several edges when trading. And I will remind, of course, in a moment what is the global context, but defining the global context may be a huge task, and so it's not necessarily always easy or simple for everyone. And this is why with the MAX, we provide two services for traders, not only the MAX trader, but also non-MAX traders, to help them choose or better choose their trades. Because what I'm going to show today, to explain today, is applicable to any trading styles and to any time frames. And so the two services we are presenting are the MAX Bias Advantage, short-term and long-term bias, and the MAX price levels. And I will illustrate each of these concepts with some examples. I will explain these concepts and I will show some examples. So, and of course, after that, we will give you an idea of the price of these services, because, as you know, there is no free lunch, and so everything has a cost. And so what is the global context? In fact, when we observe the price movement in any market, whatever the market you want to trade, the Forex, the futures market, the stock market, the bonds market, the options market, you will see movement. And these movement, if you have no culture about trading, you may have the impression that these movements are completely random. But once you begin to understand the mechanics, the mechanism of the market and the factors influencing the different markets, you realize that these movements are not random at all. There is sometimes some randomness in the movement because there are always some uncertainties or some informations we don't know in real time. And so, but most of the movements are not random at all. And in fact, they depend on the global context. What I name the global context is, in fact, the set of all the factors influencing the price movement. And among these factors, without being exhaustive, of course, because it's a complex subject, we can never be exhaustive enough, but the main factors influencing the movement are the following: the geopoliticals, of course, and I will show some examples of the geopolitical, or I will explain some of them. A very nice example we are living for several years now is the Brexit subject. And by the way, you know that tomorrow at 11 p.m. Brussels time, officially UK leave the European Union. So, and then we'll enter in the phase of negotiation for the trade relationship with the European Union. So, another important factor or factors influencing the price movement, essentially in the Forex now, is the central bank decision, either for the interest rate changes or their intervention, their operations, their daily operations. So, then another very important factor are the news releases. In fact, some news releases, when they are released, when they provide data which are completely different from the forecast, so they will create important movement. These movements may have an impact in the market for just a few hours, but sometimes for a few days or even for a few weeks. So other factors influencing the market are, of course, the relationship between the different markets, what we call inter-market relationship, because all the markets are in some way correlated, positively or negatively correlated, so each market may have an influence on the other markets. And then when we consider day trading, we have what we call in the Max courses critical time moments, because not all the moments are made equal, and so there are times during the day when we have to pay extremely attention because we may have a price reversal, not necessarily a trend reversal, but perhaps a trend exhaustion or a movement exhaustion or a price reversal. An example of such critical time moment are the well-known London close, for example, and what I call more generally the open and the close of each session. And then we may have every specific event which may have an impact in the market. We are living for just a few days a very dramatic example with the coronavirus coming from China. And so that problem is for several days now creating some fear, and even an important fear, in some markets, especially the stock market. And we may have other factors. It's almost impossible to have an exhaustive list of all these factors. We need to stay informed day after day after day for any event which may have possibly an impact in any market or segment in the market. And so when we understand these influencing factors, this will help us, in fact, to understand why the price of a specific instrument we want to trade move in a specific direction, either for short-term trades in a small time frame, for example, the 5-minute, the 15-minute, the 1-hour time frame, or for a larger position when we consider longer-term trade, for example, position trading, which may last several days, several weeks, several months, possibly. And this helps also to understand sometimes why some price levels are important. Price levels are levels where the price can perhaps accelerate in the movement, or can accelerate the movement, or the price can reverse, in fact. And so these levels will be called supply and demand levels. Let me show you, first of all, what kind of informations we provide to our members, or which are also freely available for everyone who are interested by these informations, how we present some important element of the global context on our website. But with the services we propose now, we will go one step further, of course. But let me show you, first of all, what we give as free informations to our members or person interested with these information. So every week, every Saturday, in fact, we update our website, a specific area of our website, which is called the News Watch. The News Watch list, in fact. When you go on the landing page of our website, which is www.maxtradingsystem.com, and you click on the News Watch List button, or if you complete the address, the web address with News Watch, you land on this page, and this page is made of several components. First of all, we have some geopolitical elements we have to pay attention. For example, it's clear that for the moment, and for some months again, the Brexit problem will be important. The Fed action, especially with the repo operation, are important. And the announcement about the rates, interest rates, are important also, because the market is still expecting for a cut in the interest rates. We have the similar problem linked to the Brexit with the Bank of England, where the market is waiting for an interest cut, in fact. But there are also other problems we have to pay attention on a short-term, medium-term, or long-term perspective. And so these elements are given in this webpage, and from time to time, depending on the situation, this portion of the website is updated. And then, of course, I have mentioned the news releases, and in fact, we can consult a lot of economic calendar. One we like because it is a very simple calendar to understand in terms of structure of the calendar. It's Forex Factory. But as all the other economic calendar, these calendars give too many news releases, and most of them have no influence in many markets. The market we focus the more is the Forex market, and so our news watch list is especially oriented to the Forex market. And in this section of the web page, we focus on the news which have really an impact, or which, as I should say, which may have a real impact in the market, provided the data is released with a surprise, a big surprise, a positive surprise or a negative surprise. This means that the release data must be very different from the forecast, in fact. And so for each day of the week, you see here Monday, Tuesday, Wednesday, it is this week, we mention only the news which are really important, and we make the distinction between major news and news we can only monitor. We have already presented this kind of information several times, but I will just make a summary here. The news which are really important are the news which are labeled major. And when we have a big surprise in such a major news release, we may see big movement in the market. And these movement will be important, especially in the small time frame, from the 1 minute time frame up to the 1 hour time frame. But when the news is also followed by the mentioned H4+, this means that in the case of big surprise, the impact will be also in the higher time frame, the 4 hour time frame to the daily, sometimes the weekly time frame. And then we give a description of the news release and a detailed explanation on how to interpret the information we give on this page is given here below all the data we are providing. And then we provide also pairs, the pairs which move the most at the moment, and then when we match this list of pairs with the calendar, the calendar of the news release, or the economic calendar, we are able to propose just a few pairs to monitor and to trade for each day of the week. And so all these informations are mentioned, are updated each weekend, each Saturday, in fact, just to be precise. So all these information are part of the global context, and the trader who is able to understand and to interpret this information correctly can have a good idea in which direction to trade each specific pair. But it's not so easy. It requires some work, so to do every day, sometimes several times a day, and to be informed, to stay informed of what is happening during the day, in the case the trader is an intraday trader. And because it is not so simple, we have had the idea to provide that service we call the Max Bias Advantage. It is the first service we provide called the Max Bias Advantage, which concerns two time horizons, the short-term horizon and the long-term horizon. And it is presented, it is first of all produced every day and presented in the following example. We use a Google Sheet, in fact, which is shared among all the subscribers, and so it presents that way. And in this sheet, we consider two possibilities. First of all, a short-term, as mentioned here, a short-term bias with all the information given in the sheet here. And so this sheet has several sections. The first section concerns a certain number of instruments we are following. And we have several types of assets. First of all, we have a certain number of pairs, of Forex pairs, currency pairs. So we have, first of all the major pairs, so all the pairs with the US dollar, and then an important one in the context of the Brexit, which is the Euro pound. And then we have the other pairs in our top 10 list pair I have just shown a moment ago in our news watch list. Then we have some very important indices in the stock market. We have the three main indices in USA, the S&P 500, the Dow Jones Industrial Average, the Nasdaq, and then two important indices in Europe, the DAX, which is heavily traded by many traders, and the FTSE 100 in UK, which is an important index, an interesting index in the context precisely of the Brexit. And then we propose also two commodities, two special commodities, gold and crude oil, and then other informations. For example, we have here the US Treasury bond, the European bond, so this is the bond market with two major representatives of this market, and the VIX of the S&P 500, which gives an idea of the volatility in the main stock market in USA. And so we cover that way several types of market, and we can see some correlations between these different markets. And then we have five columns named first bias, second bias, third bias, fourth bias, fifth bias. And these columns will contain the directional bias to privilege. And so these biases are represented with arrows, up arrows or down arrows, with a green arrow when it is an up arrow, red arrow when it is a down arrow, with a specific code. And so the type of bias or the importance of the bias is represented by the number of arrows. The definition is given here. When we have, in fact, only one arrow, this represents a bias which may be risky. This is a bias which is not certain to hold a long time period. When we have two arrows, this represents a normal bias. It is a bias which can last several hours. And when we have three arrows, this represents a strong bias. This is a bias which can last the entire day. Not necessarily the entire day, but it can last the entire day. And then there is a small subtleties also. Sometimes you will see, especially in the first bias columns, two asterisks following the bias, and these asterisks are not present in the other columns. In fact, when I establish these bias for all these instruments, it's around the London Open, a few minutes after the London Open. The asterisks mean that the bias has been already established previously, possibly during the ASEAN session, or perhaps possibly since the previous day. And so the two asterisks means the bias is holding and is present for possibly several hours. But when I update a bias, when I specify that there is a bias, there is automatically the time in New York time, which is indicated in the Google Sheet in an automatic way. So it is a timestamp for the bias definition. And from time to time, of course, along the day, this bias, for what any reason, a news release, for example, or someone having made a press conference, for example, with important informations, the bias can possibly change. And so I change the bias in our Google Sheet, and then there is a timestamp at the moment when I have made the change in the bias in such a way that our members, our subscribers are informed in real time when a bias has changed. And so they can access this sheet. I will explain in a moment. So this is the section for the short-term bias. And we have here on the left side a summary of the news of the day, and at the bottom of the sheet here, we have what we call session notes, and so I make a summary again of all the news we have. And then when the news is released, I make a small comment, for example, worse than expected, less than expected, better than expected, and so on. And sometimes I make a more elaborated comment. So, and generally speaking, this session notes also is also used for any other comment I need to make. For example, if I know a specific event which has happened, so I write a comment in this notes section. There is also a small text message here. If we type a text message here, there is a timestamp which is automatically defined, and every subscriber are informed of that comment. And then we have a last segment here which represent also for all these instruments, so the long-term bias. It is just a summary of the long-term bias. So I will show in a moment the long-term bias too in a more detailed way. So now there is another mechanism to inform the subscribers when there is a change in a bias. This Google Sheet is linked with a tool, a messaging tool, which is called Slack. And when a subscriber is connected to Slack, so it will be informed automatically with a message in Slack that an update has been made in a specific instrument. So this is the short-term bias. So I have two examples. One was a few days ago. This one was today. And then let me show you some example of these bias. On that day, for example, my next slide is a pair. The pair was the pound Aussie. And if we look in the sheet for the pound Aussie, we can see that the bias was short for the entire day. And has stayed short for the entire day. At the London Open, in fact 18 minutes after the London Open, I have established that the bias was to the downside, a short bias, and it has stayed short for the entire day. There has been no change in the bias. And if we observe the chart here, I have drawn here a vertical line, red line, when I have established or when I have updated the bias in the Google Sheet. And the second vertical line was the moment when I have stopped my trading session. And we can see that the bias was short. So we have avoided, following the bias, we have avoided that pullback, which was a deep pullback, but we could have traded nicely this down movement with a nice trade using the whatever techniques to trade you want. For example, it may be one of the max technique, the max primer or the max standard. So a very nice trade on this example. A second example was, for example, the pound card. And for the pound card, the bias was also short. The color is not correct. When we save the Google Sheet into an Excel spreadsheet, this is a screenshot of an Excel spreadsheet, the color are not always respected. I don't know why, so there is some small problems in the update between the copy or the download from the Google Sheet to an Excel spreadsheet, but the bias was to the downside. And so here we can see on the pound card that again, so we had to trade short, and so a nice down movement which would have been traded with the max. So this is for the short-term bias. But we have also, for example, an example with an index, the Nasdaq. If we go back to the sheet, we can see that here for the Nasdaq, so the bias has changed. I have had three bias: long on the London Open, then 2 hours later the bias has changed to the downside, and then 5 hours later the bias has changed again to the upside. And so let's check on the chart now. So here is the Nasdaq. The long bias is represented when I have updated the bias by a green vertical line. So we had two green vertical lines, and then the red vertical line represents the short bias. So we can see that in all that time period, it would have been impossible to trade except a small short trade here, representing this pullback. But then the big trade of the day was this long trade given with this long bias, and so a nice long trade which would have been traded possibly with scaling using the max ETF standard approach, for example. So this is the way the traders can use these short-term bias, either using the max, any level of the max, or any other trading system. And then we have the long-term bias. The long-term bias are bias which can be used for higher time frames, so the 4-hour time frame, the daily time frame, the weekly time frame. And the idea is exactly the same, but the number of instruments I consider is a little more important. In the Forex, I consider the 28 pairs made of the 8 main currencies, and then we have the same other instruments, so the 5 indices, the S&P 500, the Dow Jones, the Nasdaq, the DAX, the FTSE, gold, crude oil, and then the 3 other instruments, 2 on the bond, the US Treasury bonds and the Euro bond, and the VIX S&P 500. You know that the VIX can be traded through specific ETFs, for example. And so whenever the bias is changed or has been established, there is also automatically the day and the time which are introduced in the Google Sheet. And you can see that some bias have been established even in December, for example, the EuroCAD, so with a down, short bias since December 23. And you can check the EuroCAD chart and you will see that the EuroCAD is indeed going downwards. And so let me show you some example here. So the Aussie US dollar. The Aussie US dollar, if we look here, the Aussie US dollar is short, and I have updated, it is a service which is new, so I have updated the short bias on the 20th of January. And if we observe here on a 4-hour chart, this red vertical line represents the 20th of January, and we can see that indeed the price has moved to the downside, in fact. So the bias was perfectly correct. If we look on the crude oil, if we go back to the sheet, we see that the bias, when I have updated the last time the bias, it was on the 12th of January. So 2 weeks ago, 3 weeks ago, with a short bias. And if we observe the crude oil chart, we can see that since the 12th of January, the bias is indeed to the downside. So again, the bias was correct, and this would have helped to make a nice short trade with a long-term horizon. So this is for the max bias advantage. So we may provide trading bias, directional bias for short-term and for long-term traders. The short-term can be used for small time frame, 1 minute, 5 minutes, 15 minutes, 30 minutes, 1 hour, and the long-term bias may be used for higher time frame, 4 hour, daily time frame, weekly time frame. So the second service we propose is a service we have already proposed in the past, but in a less formal way. It's what we call the max price levels, which represent possible levels of supply and demand. And you know that if the price reaches indeed a supply level, most of the time, or I should not say most of the time, but it is possible that the price will reverse from an uptrend to a downtrend. On the contrary, if the price reaches a demand level, because the price is going downward and reaches a demand level, this may be a level where the price will reverse to the upside. Now, these levels we provide are produced every Sunday, every weekend, and they are valid for the entire coming week. So they are sent to each of our subscribers on the Sunday as a zip file. Each zip file contains the template for MetaTrader 4, for each instrument in the package, and we have a script allowing for the trader to load these levels in their chart on MetaTrader, and the procedure is explained when a customer subscribes to this service, of course. And the procedure is very simple. And the idea is the following. Let's, for example, here the pound yen on a daily time frame. And on this chart, it is a naked chart, but the levels can be applied to any chart with their specific templates. But I have taken here a naked chart, and you can see several types of horizontal lines. We have a line in red, in magenta, in orange, in white, in purple. These are possible level of supply and demand in different time frames. Now, this does not mean that we have to use them in their specific time frames. No, it means that we have used these specific time frames to better identify some specific levels. And the color is just a reminder of the time frame we have used, because some supply and demand level are more easily visible when we use specific time frames. But if we have a supply demand, for example, which has been used or established with the 4-hour time frame, this supply demand can, of course, be used in any time frame, like the 5 minute, the 15 minute, the 30 minute, but also the daily time frame. And we have a specific type of horizontal line, which are here these dashed blue aqua horizontal line, which represent other types of levels where the big boys also are again possibly acting on these levels. And you can observe on this example, so this is the chart of the pound yen, so with the last days, 1, 2, 3, 4 days, so this week, and these levels have been established during the weekend here. So during the weekend at the end of the last week and the beginning of this week. And you can see that as soon as the market has opened, the pound yen has continued to go downside, but has reversed exactly on this magenta level and then has pushed higher, reaching here this area where we have these dashed line levels. So you can see that on these two other orange lines, the price has made a small pause before crossing these levels and then reversing on this blue level. Then the price has made a pullback, and when the price has reached, in fact, this level, we can say that this level is obviously a demand level, because whenever the price reaches this level, the price is reversing to the upside until finally some kind of imbalance. This is an accumulation area. So when an imbalance is created, so the price moves upward, possibly crossing or pausing on some other level. We can see, for example, here the price is making a small top followed with a pullback on this level. The pullback is stopped on the next, on the previous level, and then the price bounces off, make a pause on the next level, and then push upward, make a small pause on this level, and then makes a push to the upside, and finally reverses on this specific level. We never know in advance on which level, of course, the price will reverse, but we get informed that whenever the price reaches a specific level, something may happen on these levels. And so these kinds of levels may be, in a very interesting way, may be used as tools in our trade risk management approach. And so this means that whenever the price reaches one level and seems to reject this level, we can bank a partial profit, or we can close a portion of our trade position. So this is what we call in the MAX methodology an MX momentum exit. So this is an example of the pound yen in the daily time frame, but of course it works in other time frame. For example, in the 1 hour time frame, it is the same chart, and we can see clearly how the price reacts around these levels. So, and sometimes just by the pips or by a few pips, so they may be extremely, look here how the price is stopping on this level which has been established 1 week ago. Okay. Another example is the US dollar yen, a major pair in the 4 hour time frame, and we can see exactly the same way. So how the price is reacting along these levels. Sometimes a level is used as supply demand and the price reverses. Some levels may be demand level. For example, here we have a demand level when the price takes off, and sometimes the price pauses on some levels, and so these levels may be area where the trader can consider to take a partial profit when he is in profit, or to limit his risk if he is at a loss. So the 4 hour time frame is the smallest of the higher time frames, but we can use also a smaller time frame. For example, here it is the 1 hour time frame, and we see also the relationship, a clear relationship between the price behavior and these levels. And these levels can be used in any time frame. For example, the 1 hour time frame, here it is the 15-minute time frame, so a very short time frame. In a smaller time frame, we will see less levels, of course, but they are all present on the chart. And we can see, again, how the price will react when reaching these levels. Of course, the price can react before reaching a level. This means that perhaps there is a level which has been missed here. Perhaps this may happen, because they are not necessarily all visible in a chart. But the price will almost always react on this level. Sometimes it can cross a little bit a level and then comes back. In fact, a level is never a thin line. It must be considered as an area around which the price may react in a specific way, either crossing the level to try to reach the next level or to reverse on that level. So And so these are the two levels we provide. And so now you can ask, okay, but what is the cost of these two services? So we provide a 1 month trial period, which will start in the 4th of February. So I think it's next week, Monday next week. And the cost of this trial period is for the BIOS only. So for the short-term BIOS and the long-term BIOS using the Google Sheet and Slack, the subscription is $39. The subscription for the levels only is $29, but we can also propose a bundle combining the two services, so for only $59 per month. So the trial period is only for 1 month. So for the levels, we provide the levels for approximately 30 instruments. So, and among these 30 instruments, we have many of the pairs in the Forex we consider for the BIOS. In fact, we have all of them. We have all the majors. We have all the important pairs we have in our top 10 list. We have also the different indices I have mentioned, so the S&P 500, the Dow Jones, the NASDAQ, the DAX, the FTSE. We have gold, we have crude oil, and we have also the Bitcoins, because some of our Max members in the past have asked for the for some cryptocurrencies, and so I have considered the Bitcoin, even if myself I don't trade these instruments. So, and then after the trial period, so we have the regular subscription starting in March the 4th, and then for the BIOS only, so the short-term BIOS and the long-term BIOS, the monthly subscription will be $59 per month. The levels only will be $49 per month, and the bundle, so the BIOS and the levels, will be $79 per month. So now, of course, if you have any questions about these two services, of course, Craig, Chris, and myself, we will be glad to answer all your questions. So. And the link to subscribe to the services will be given by Craig in a moment in the chat area of GoToWebinar. So, but if you have any questions, even after this presentation, there is always the possibility to contact us. So either by email or by Skype. So this is why we always give our contact information. So, and I see that Chris has indeed posted the link in the chat area of GoToWebinar, so for the service bundle. So, any questions or any information you would like to have from us? So Hector asked, I missed the levels part a bit. I didn't quite get it. In fact, the levels are, let's consider again a chart. Let's take, for example, this one, the US dollar yen in the 1 hour time frame. So the levels are these horizontal lines. Again, the colors are not important. What is important is the levels of these lines. And if I would like to make it simple, even if it is not an accurate description, they represent support and resistance levels. But in fact, they are not support and resistance level. They are in fact supply and demand levels, where the price, because of the volume activity along the price movement, may react in a certain way. And so you can include these levels in any trading approach as a way to consider either a target profit or if you are in this short trade, for example, if you are trading the US dollar yen short and the price is reaching this level, you see that we have here, we see two levels, and the price seems to pause on this level. If the price has a tendency to bounce off from these two levels, at this point, just a little above, you can close a portion of your position and bank some profit. And then when the price crosses this level, you stay in the trade, and then you can see that on the next day, the 1 hour time frame, on the next day, the price came very close to these price levels, and the price has a tendency to bounce off from that level. And at this point, you can, for example, close your trade. So you can exactly use these levels exactly as support or resistance level. Similarly, when you have to open a trade, let's consider, for example, you are looking for a short setup in all this area. While the price is approaching these two price levels, you will not open your trade, but as soon as the price seems to reject this level, you can open your short trade and then handle the trade exactly the way I have explained a moment ago. Okay? Aruna says cannot open the link. So Chris, can you check if the link is working? So I'm going to check on myself. Okay. Okay, Hector, fine. If you click on the link, it's just enough to click on the link. I have made that, Arunas, and it works for me. Yeah, it's working here. Yeah, just click on the link. So, yeah, but I have explained, Hector, the time frame is not important. Here, the color is just a reminder of the time frame I have used myself to establish these levels. Because as I have explained a moment ago, some levels are better visible in specific time frame. No, don't need to say, oh my bad. So some levels are better determined when we observe some time frame. And it is just a reminder of the time frame I have used. So, however, the time frame is still important. For example, let's come back here on a higher time frame example. Let's take here the daily time frame, okay, with the pound yen. And when we are trading the daily time frame, it's clear that the smaller time frame levels, for example, the 1 hour level, are perhaps less important. And so because the distance between daily 1 hour levels will be smaller. And so the trader on his chart can delete, when trading the daily time frame, can delete the 1 hour levels. Personally, I will keep the 4 hour, the daily and the weekly, of course, but when trading the daily time frame, we can delete the smaller time frame. If the trader decides to trade on a weekly time frame, for example, he can possibly delete the 1 hour and the 4 hour levels, so because they are less important in these higher time frames. Robert, do you supply levels for futures? Not for the moment, Robert. No. However, so as I have said, so so these levels may be used, of course, for all the majors, and so you know that you can trade the majors as currency futures. Okay. For example, the Euro-US dollar corresponds to the 6E. Let's say the GBP US dollar corresponds to the 6J, I think, if I'm not wrong. So you can use these levels for the currency futures. I give also the levels for the indices. So if you trade, for example, the S&P 500, if you trade the DAX, if you trade the NASDAQ, you can use these levels for these indices. If you trade gold and crude oil in the futures market, because you can trade these instruments in the futures market, you can use these levels in the futures market. But for the moment, we do not provide a tool to import these levels on a platform like, for example, NinjaTrader. Yeah. And Robert, my bet cold is improving, so thanks. I'm way better. It's almost behind me. Thanks everybody for your presence, and see you next time. And in the meantime, take care. Bye everyone.